Good evening, one and all. I, Latika Karnani, Assistant Professor, Department of Management Studies, ITM as well as Baroda University, is here to present you a topic of dividend policy and value of firm with the help of case study. So now we will be going ahead with the case study of AC company, with which we'll see how important the dividend decision is for any organization. So now I'm going to share with you one presentation where there is a case study with AC Company Limited. Here, the case study is on the AC company. AC company is dealing with its profitability and the reduction of the cost and managing its fund. Also on the completing its previous orders. So, and you need to suggest here, and also here we need to suggest company the dividend decision for the year 2015. 3 years data is given to you, 2012, 13 and 14. So we need to suggest the company the dividend decision for the year 2015. Also we need to identify the financial condition of a company. Here I have noted down few facts from the case, and they are as below. Facts from the case is the company has increased in its profitability. Company's profits are increasing since 2012 to 2014. The reason behind increasing profitability is that company has adopted a cost reduction and fund management strategy, and also company is concentrating on the reduction of its holding period in inventory and the debts in the debtors, right, and converting inventory into cash very early than previous. Also company has adopted a conservative debt policy. Conservative debt policy means company has reduced its debt proportion. Compressor AC company is in compressor industry. Experts are forecasting that compressor industry is expected to grow by 10%, and AC company being the second most in the industry, second top in the industry, is expecting the growth of 15 to 20% in its sales and demand in the year 2050. So company is on its growth part. Company is on its growth phase. There are three category of the firms. One is in the growth, second is on the declining, and third is on the stable. So I'll move ahead with my facts from the case. Company has also invested its money into the assets, that is gross block, fixed assets. Company has increased its gross block from 20 crores to 22 crores in the year 2014. Company has also planned an investment of rupees 5 crore in its Pune factory in the year 2015, and company's profit earning ratio seems to be 32. Higher the PE ratio, better the company's financial position is. Now what PE ratio is? What is the formula for PE ratio? PE ratio is the proportion, or is the proportion that you get by dividing earning per share from the market price. PE ratio is equals to market price upon earning per share, which means the investor P ratio is the amount or the number of times the investor is ready to pay as price by earning 1 rupee in by earning 1 rupee. For example, PE ratio is 10 times, right? PE ratio is always in the times, correct? If PE ratio is 10, which means an investor is ready to pay 10 times of its share price by earning rupee 1. From its by earning a profit, the companies or sorry the investor is ready to pay 10 times more, right? So that is the meaning of PE ratio. Company's PE ratio is seems to be 32. More the PE ratio, better the financial position of a company is. PE ratio is equals to share price upon earning per share, which means P ratio is always mentioned as the times, not in percentage, not in value. P ratio is always in times, which means the number of times the investor is ready to pay for its earning, right? More the PE ratio means investor is expecting a good return from the company and is ready to pay more and more for purchasing that share now. So higher the PE ratio, better for the company and for the investors as well. PE ratio is based on a future expectation of the investors, and there is an inverse relationship of PE ratio and the cost. In expectation, further moving ahead from the facts from the case, in expectation of good performance of company share, in expectation, further moving ahead, in expectation of good performance from companies share prices have increased from 190 to 285, and also company is adopting a stable dividend policy. In the year 2012 and 13, company has adopted 10% dividend policy. I'll move ahead with the data from the case, the data which is available from the case, right? There is 3 years data that is available, that is in the year 2012, 13 and 14. Sales have increased from, in the year 2012 it has increased from 53.4 crores to 75.6 crores, but it has shown a little decrease in the year 14, 69.5, which means here the company or organization, that is AC company, is focusing more on completing the pending and the previous year's order rather than focusing more on sales. But though the company sales have increased, company is able to generate, company is able to manage its profit higher from 13 to 14. How is that possible? That is possible because company has gone for a cost reduction. Company is focusing on cost reduction and low operating cost by converting the inventory into cash very early. And here the net profits have also shown a steep increase from 1.3 crore to 5.9 crore. So definitely the company's earning per share is going to increase from 1.8 rupee in 13 to 8.1 rupee in 14. Right? Earning per share, we get earning per share by dividing net profit upon number of equity shares, right? So if net profit is increasing, definitely it is going to reflect in the earning per share of a company. So I'll move ahead with the questions that we need to sort out from the case, from the noted down facts from the case, right? What is that? First question is, we need to identify company's financial condition, where the company's finances are moving and what they are telling us, right? Second is, company's management was wondering whether it can go for a higher dividend declaration policy in 15. So we need to suggest the company about the dividend declaration. We need to help the company for the dividend declaration policy with the proper justification.